Hi guys, welcome to the third trading strategy that I'm going to teach you this week. So this strategy is way more common, all right? You may find it in every day, but trading it could be a bit more difficult, and it could be providing reversals, continuation, or closure of gaps. So in this trading strategy, we will follow the same concept of the trading strategy 1 and 2. We are looking for closure of liquidity voids or liquidity gaps. But today it's more likely about the liquidity that is resting within the fair value gaps, or where the market is one-sided and it wants to reverse into the opposite side. So first of all, I want to go to the daily chart. I'm showing you a NASDAQ daily chart. So what I want to understand is that there is some sort of liquidity that has been swept in NASDAQ, that is swept over there. Let me just remove that. So once that liquidity sweep is done, I can see that there is an order block that has pushed the price higher. So the price did not go back to this volume imbalance, which I think it would come back to it. And if it will come back to this volume imbalance, it can mean two things. Either price will jump back off to the higher highs, right, making new all-time highs on NASDAQ, or the price will continue to sink down on the NASDAQ. This is what I want to see on the daily charts. And then I move next. I see another order block that's over here. So there was a liquidity void that's very small here on the daily chart. If you can see it, this volume imbalance that was here was already filled. So there's an order block here that also jumped off from, and the orders just pushed it on the long side. Okay, so we have two volume imbalances at the bottom, similarly to what we have in the gold. Over here, another order block. Price jumped, almost jumped from it, and it kept going higher and higher. Now I want to go to the 4 hours. What's happening in the 4 hours? Is there any fair value gap that I want to identify in the 4 hours? Yes. As you can see here, the price has jumped heavily during this day. So it left a huge gap. A fair value gap is a gap between 3 candles. Okay, so you need to have 3 candles in order to identify a fair value gap. Okay, if the candle does not have any price action traded through it, that's a fair value gap. Okay, when there is no price action volume driving through it. So fair value gap can also be understood as a liquidity void within the candle. So in this candle, from this price to that wick, the body of the candle has not seen any price traded through it. So in the upcoming days, we have seen the price going back through it 50% and then rising back up. The 50% mark of the fair value gap is a very strong trade. If traders want to do a trade through this days, the 50% of this candle, which signifies a fair value gap, is a very strong trade. I'm not saying that you should immediately trade on this 50% based on the 4 hours. No, you should delve into or jump into the lower time frames in order to confirm this trading strategy. Since I highlighted this, let us go to the 1 hour chart. In the 1 hour chart, I can see the price has rejected this 50% multiple times. Okay, this is the fair value gap. This is how we're trying to trade it. If price wants to close this fair value gap, it should, at least one of these candles or some of these candles should close below the 50%. But since all of them are providing wicks and jumping immediately off the 50%, I can see that over here there is an order block. Okay, let me highlight it. An order block performed after the 50% of the fair value gap. So what I understand here is that the price wants to push higher. It does not want to push lower. So from this order block, I will take my entry high. The order block could also persist here, but I'm not sure of it. So I'll go delve into 30 minutes. Does the order block still show me a confirmation on that one? Yes, there is a furthermore order block here. These 3 candles here, all of these down close candles there, they signify an order block, and I can see the price traded through it and then immediately jumped over and kept moving higher. Okay, there's another order block in the 30 minutes. Let me just lock down this fair value gap. Lock it back into this place, lock. Okay, so this fair value gap is still persistent, yeah? There's still a fair value gap here in this price. If I want to further identify this one, I'll just do it like that. There's still this price that has not been traded through it. Okay, taking this candle there, and that candle. So there is a fair value gap there. And you can see that how the price is reacting to it. 50% of it wakes through it, goes up higher. And there's our refinement of the order block. There's another order block there. Okay, this is what I call it. Down close candle, and then an up close candle, piercing through that down close candle, going higher above it, closing above it. And that signifies to me an order block. Does price completely close the order block? No, it's still leaving this portion open, which confirms the bullish trend. I move forward in price. This is 50% closure of the fair value gap. I move forward in price. I keep moving it forward. Price goes below the 50% and provides a sort of efficient market in the trading sessions. So over here, I can see that market is providing some efficiency to this fair value gap, and it's closing almost 100% or 80% of the fair value gap. And this is called efficient market. It still has a tiny bit that needs to be filled, but it's not necessarily for it to go and fill it. Okay, it's not necessary to fill it 100% all the time. It assures me that this is quite enough. Okay, this makes me quite satisfied that it has closed this provided efficient market, and our price could rally above it. If I see this, there are some trades within this trading session. I go deeper, 15 minutes. I always like to study the previous days before I jump to the current day. So I will jump to the current day in a bit. I want to see it in the 15 minutes charts first. So in the 15 minutes chart, we have these 2 down close candles that I've explained in the second trading strategy. These 2 down close candles are providing an order block. As you can see, price jumps into it, okay? Price almost taps into this order block and then immediately moves up higher. You may use, okay? You may use the wick of that 2 down close candles. But I always prefer to use the bodies. The bodies are always much preferred. I'll delete this order block there. The bodies are always much preferred when doing the order blocks. Okay, so we see price trading back through it slightly and then pushing upwards. Price trades back to it once again to this top of the wick here and then pushes even higher and higher. In this price action, we can see that there is a fair value gap. This small fair value gap. Okay, price leaves it open. If price traded through this fair value gap, this could be a breakaway gap as well. However, we will keep this gap open, all right, and we'll go to the next candle. Is there also a gap? Yes, there is. And what does the price do? Price trades through this, okay? This is why I'm telling you, the fair value gaps are quite important. The closure of the gaps, or at least some sort of closure of the gaps, liquidity void, or jumping back into the liquidity void, taking orders will result in very strong momentum trades. Okay, it will give you confirmation later on. We see the price trade back through it. This is what we call a breakaway gap. Okay, so in this gap that it has performed, it kept this gap over here open. There's another gap here open, and then there is this gap. If price trades through this gap and leaves it open, all right, this is a risky trade for me. But since I've seen that there could be in the 15 minutes, there could be a jump in liquidity, and there is this liquidity void that's here, which price tends to close it. If I see an order block there, I will immediately join this order to go long. Okay, my stop loss would be below this fair value gap. My stop loss would be there. So if I show you in terms of trade, it will be there. I'll explain the reasoning behind this, okay, and why I'm taking this order. So when the traders or institutional traders are trading through the market, they tend to leave liquidity gaps because there are a very huge amount of orders that are being filled, and they don't want to revisit these orders, okay? So when the volume or volatility of the market is very high, the market will always keep pushing forward, keep pushing long in one direction, okay? It will keep pushing in a single direction and leaving gaps behind it. When the market tends to go back to these gaps can be understood as order blocks, okay? They are also referred to as liquidity voids. If this liquidity void is being filled, okay, we can expect some sort of reversal. We do not enter as soon as we see the closure of the gap because there are other gaps that might be closed below it. If the price provides us a reversal and provides us an order block, we will enter at the order block. You may risk it, okay? You may provide a risk factor once this down close candle closes and the next candle starts to trade. So at this 50%, let's do a marking for that one. If this 50% is traded through, okay? If this 50% is traded through, we do not trade it on a 15 minutes. It's quite a big time frame as well. We go down to the 5 minutes. Let us investigate that one. Okay, so in the 5 minutes, we can see a confirmation of the order blocks. There's a liquidity void being snapped to it. If we have traded through this one, we might notice that this could be a fake bearish order block. So what our mind would tell us is that when we are doing this trade, this could be a bearish order block in our strategies. But no, we have to see it on multiple time frames to confirm the order block. We cannot issue a trade just immediately on the lower time frames. The lower time frames may confuse you when referring to these breakaway gaps. You have to always refer to the higher time frames before initiating an order in a lower time frame. The higher time frames will provide you the concept of the fair value gap closure in this strategy. Whenever I see this could be the order block that I'm looking for, but it doesn't provide me any time to trade it. So in the 5 minutes, I'll mark it here. This is an order block in the 5 minutes. If I go back to the 1 minute chart, and I try to find that day, if anyone knows how to snap back to the point, that will be quite helpful. I need to look into it. I'll keep running back to it, so just give me a second. There's quite a lot of 1 minute charts that I need to go and look into it. If the price does not allow me to go back, that means that's it. I'll go look for another example. Yeah, price does not allow me to go all the way back. Okay, so the maximum I can go back to is Sunday, May 25th for the 1 minute. Is that right? Doesn't make sense. Okay, so unfortunately I cannot show you on that one, on the 1 minute. So I'll go to the 5 minutes again and perhaps we can find it. I'll try to explain the reasoning why we cannot. Okay, so in these 5 minute charts, perhaps in the 1 minute chart, it will provide us a better auto block theory that could be seen here. So we could trade within this discounted area down below here. Maybe the 1 minute chart could provide us an order block below here, below this 50%. So below this 50%, it is a discounted region. We may take the price long. This price action that's over here may be called a breakaway gap. In the higher time frame, we have marked it on the 15 minutes that there is a breakaway gap that is shown here. So in this breakaway gap, if price trades below the 50% of this gap, we should consider ourselves as buyers, okay? If we want to get further confirmation on it, then we can perhaps wait for an order block to show up and trade from that order block, as I've shown you in the high time frames. My stop loss would be below this fair value gap, okay? To be below this breakaway gap, just to make the stop loss quite a very good one, okay? So what I'm doing is that at this stop loss, I'm entering at 93, 94, and I have a 33 point stop loss. For example, in the 1 minute, I may enter at this point here, reducing my stop loss to 21 points. If in the 1 minute chart, it provided me a stop loss, it provided me a better trade at the 50% line, my stop loss would be 15 points. So this is how I would set my trades. I need to confirm it on a high time frame and then go to the lower time frame. The breakaway gap is left open. The price kept rallying from it. We have another gap that we need to look at. There's this gap here, from this price to this price. Do you see any price action going back to it and wicking through it? No. So we take it all the way there, and we see that the price has dropped back down to it, okay? Has dropped down back to this liquidity void or the fair value gap. And what do we see next? An order block. As soon as an order block is performed, I can see that my trade will be bullish during these days, okay? During this day, my trade is bullish. What I will do, I will take a trade, long, again. So I'll set my stop loss there. Where is my stop loss is right below this candle, below the order block, okay? And I extend it. How much I'm risking? 40 points. This is quite a risky trade, okay? But if you go to the 1 minute chart, it could be further refined. This is all 5 minute charts, 5 minutes, 5 minutes. So your stop loss could actually be one of these, your order could be one of these candles and you're going right below there perhaps. Perhaps that would be your stop loss, 33 points, instead of having it all the way there. So this is a huge candle. I'll take 2 to 3 times of it. I'll target these highs over there and I take my stop loss out. So that is a 1 to 2 trade, okay? I will not close all my trades because I can see the buy side liquidity is there. I will not close all my trades. So my trade could actually end over here, these equal highs. But I don't want to risk it too much. So whenever I have every single equal highs, I take off for my trade a bit, okay? So over here, this will be like an 82 points trade. If I want to risk it and leave the remaining points, like I'll leave one contract all the way up there, it will result in 150 points almost, okay? Depending on your trade entry. Let's go to the current trading sessions, okay? You can see there's a fair value gap there in the 5 minutes. Let's jump backwards into the high time frame, 15 minutes. Let's clear out all the markings that we have. Okay, now we are almost at the current days, okay? So This is Friday. So in Friday, I took this trade all the way up there. The reason that I had is that there is a volume imbalance. I mean, there's a liquidity void. There's one. Okay. There is another one. Okay. And there is another one here. Okay. So each time the price goes back to one of these, there is some sort of trade going on. Okay. And there is also one at the bottom here. Okay. So when I was looking at these very strong bearish candles that were happening during the London session, as soon as we hit the New York session, I was saying to myself that if there is any sort of reversal, then it will definitely close one of these fair value gaps. So what I did is that I started to look at the price at 9 a.m. Okay, so I had to look at the price at 8 a.m., but then I looked at it at 9 a.m. So when I looked at it at 9 a.m., I found that there is a bullish order block that is sitting right here. That's a bullish order block. All right. So what does the bullish order block do? It provides us a very huge chance of trading from the bottoms all the way to the highs. My trade came in at this high. So I set my trade there, my stop loss there, below the order block. How much I'm risking was this much. It's not to the closure, but yeah. Why did I do this huge stop loss? Because I knew that there is an order block there of persisting of 2 candles. I do not enter at this piercing candle, although it shows the trade is closed there, but it's not actually closed. I'm entering right at this point here. Yeah. So if I may say, I need to push this a bit to the right. I'm entering right there. Yeah, that's my trade entry. 1 second. I think it should be 1 candle there. Yeah. Not quite sure. Okay, let me just drop it below. Yeah. So my trade consisted of this option. I said to myself, if I'm entering at this point here, my exit should be there. That's the first exit. I took off some of the orders and I let it continue. The next strong trade that I had in mind is the 50% of this fair value gap or liquidity void. There's an inefficiency in the market when it's going all the way down there, leaving a huge amount of gaps difference, almost 100 points, okay? Almost 100 points, and here 50 points to 60, yeah? And here there's another points, like around 20 to 30 points over there. This is the huge one. I knew that price, if it reversed and provided me an order block, it would try to close most of these gaps, liquidity fair value gaps. So the fair value gap, you need to understand it. It is sort of a gap that could reverse the price from it, providing efficient pricing, okay, when it's trading back through it, and then it could reverse, okay? So our content for this time is that whenever we see price is trying to close those fair value gaps, okay, fair value gaps, whenever it's trying to close them, we tend to formulate an idea of using the order blocks to trade those fair value gaps. So fair value gaps could be our entry point and it could be our trade target. So this is how the strategy works. This strategy provides itself almost every single day, okay? But you should not overexhaust your trade. If the trade is late in the afternoon and it still hasn't reached the 50%, exit the trades and be satisfied with what you have. You should take most of your trades at the bottom of this fair value gap. That's what I did. I took 2 contracts off. I took 1 contract here within this fair value gap closure, and I took 2 contracts here and 2 contracts at the middle of there. So I hedged my profits and I took the sum of all of them. All right. So that's what you should do. I've risked 60 to 70 points. All right. But I knew that the price would not be going back downwards because there's a huge volume imbalance or liquidity void that is being kept here. Why do I say volume imbalance? Because there's no efficiency in trading when it leaves these huge down close candles without price action providing efficiency through it. Price has to trade through it to provide an efficient trading. I do not force the market. I do not say to the market that, oh, you should go there and it should go there. You should be satisfied with what you're getting. You trade it up there, you close the trade, you do not expect the trade to go all the way up there. Okay, this is my third strategy, fair value gaps closure, and using older blocks with liquidity sweeps as well. All right, guys, see you next time on the other strategy as well.